Good afternoon and welcome to Nature's Returns, Investing in Ecosystem Services, a webinar series hosted by the Yale Center for Business and the Environment. My name is Amy Torget and I will be your host for today's presentation. The Nature's Returns webinar series addresses the growing importance of ecosystem service valuation and investment. Each presentation is recorded and available from CBay through YouTube and on the Yale iTunes U channel. Today, we are excited to be talking about investment in the U.S. sustainable agriculture market with our guests, Peter Stein and David Nicola. Peter Stein serves as the managing director of Lyme Timber. Peter joined Lyme in 1990 and has significant experience in conservation-oriented forest land and rural land purchases and dispositions. Peter develops conservation sales strategies on properties being evaluated or managed by Lyme and also leads Lyme's conservation advisory business. Prior to his career with LTC Partners and Lyme, Peter was Senior Vice President of the Trust for Public Land, where he directed TPL's conservation real estate acquisitions in the Northeast and Midwest. Peter lectures frequently at graduate schools and professional conferences on conservation investment structures and strategies. He is a member of the Board of Advisors of the Appalachian Mountain Club and serves on the boards of the Forest History Society and the National Alliance of Forest Owners. In addition, he is a former board chair of the Land Trust Alliance, served as a founding commissioner of the Land Trust Accreditation Commission, and serves as a member of the advisory board of Rose Smart Growth Real Estate Fund No. 1. Peter is the co-founder of the Conservation Finance Network and the International Land Conservation Network. Peter earned a BA with highest honors from the University of California at Santa Cruz and was a Loeb Fellow and received a certificate in advanced environmental studies from Harvard University. Our second guest, David Nicola, is the founder of Blackdirt Capital, a firm that develops farmland, real estate, and value chain-based investment strategies in the U.S. sustainable agriculture sector on behalf of investors. Blackdirt's current focus includes investing in undervalued and underutilized farmland assets in the eastern U.S. and operating these assets on behalf of investors. Blackdirt unlocks embedded value via a focus on grass-fed production, premium sustainable food markets, and by cultivating strong connections throughout the value chain. Blackdirt currently operates an existing farm in eastern Georgia and has a robust pipeline of additional farmland assets, farm managers, and offtake partners, which he'll talk more about. David has 14 years of investment experience in farmland, private equity, portfolio management, and credit trading. Prior to founding Blackdirt Capital, David served as a portfolio manager at Blue Mountain Capital Management, a director of investments at a Connecticut-based family office focused on food and agriculture, and an investment banking analyst at Citigroup. David holds an MBA from Duke University's Fuqua School of Business and a BS from Cornell University's College of Agriculture and Life Sciences. We are very excited to have them both here today. During today's webinar, Peter and Dave will first provide some background on Lyme Timber and Blackdirt's work and strategy driving conservation. Then Peter will touch on his perspective on the sustainable agriculture market and how it is similar or different from the timber market. Finally, Peter and Dave will engage in a discussion about conservation strategies, ecological benefits, and investor interest in the sector. We are hoping to leave about 20 minutes for Q&A, so please make sure to submit all your questions and we can have an in-depth discussion with Peter and Dave. You can type your questions in the Q&A section of your screen throughout the presentation. We will collect them and I will present them to our guests at the end of the webinar. All right, let's get started. Peter, Dave?
Well, thank you for hosting us, and it's a pleasure to be talking to everybody who has signed up for the webinar. And I really look forward to the conversation that I will have with Dave in a few minutes. For those of you, if you want to put up the first slide, Lyme Timber has been around for a long time. For those of you who know me, who are listening in, you know I've been doing this work for quite a while. We have a great team at Lyme Timber that principally focused on high conservation value forests. They are determined to be of high conservation value by our great land conservation NGO partners, such as the Conservation Fund, the Nature Conservancy, the Trust for Public Land, and a variety of regional and local land trusts that we've worked with around the country, as well as being identified as important habitat lands by things like the state wildlife action plans that state natural resource agencies have generated over the last decade. Our work is principally in the US and a little bit in Canada, without reading every word on this slide, you can see that we principally work in the eastern half of the United States, where there's more private land than the western half of the United States. But we do have a major investment in Northern California, in Mendocino County. And we did do one agricultural investment, and that's sort of in the center of the slide in southeastern Colorado, in partnership with the Colorado chapter of the Nature Conservancy and a great regional land trust in Colorado Springs called Palmer Land Trust. We acquired a 25,000 acre cattle ranch that was the missing component in a wildlife corridor that went from the New Mexico border north of Colorado Springs. And it had been identified as a conservation target for many years. We were able to acquire the property, and then work with our NGO partners to secure conservation easement dollars from the Great Outdoors Colorado Trust, which is a wonderful state funding program in Colorado. Let's go to the next slide. So for those of you who want to understand how we create value, the timberland asset class is now quite mature, and no longer are there what I would term uninformed sellers. So everybody who owns timberland, when they bring it to market, when they want to exit from a fund or from a separate account, or for whatever reason the property is available for purchase, the seller expects to receive full value, and full value usually exceeds the capitalized value of the timber income stream on the property. And so if you're forced to pay full value, you want to monetize that portion of it that has nothing to do with timber. And we monetize that through what's called phase 2, the sale of a conservation easement. And I think probably everybody on this call is familiar with conservation easements, but it's basically a portion of the property rights that are acquired. So the property rights that we dispose of through a conservation easement typically have to do with the ability to convert the property to another land use, like some type of real estate development, or even just a parcelization or fragmentation of the property into smaller sale units. Second, there's typically some type of public recreation that is secured through the acquisition of a conservation easement. And third, our forest management techniques and activities on the property have to exceed letter of the law requirements. And the best way for folks to understand that is typically now, probably for the last 10 years, the conservation easements that we work with require third-party certification of the timber management activities on the property, and that can be done through the Sustainable Forestry Initiative or the Forest Stewardship Council. In the event that those certification programs disappear or are no longer viable, then the holder of the easement has the rights to approve our forest management activities, typically a rolling 5-year forest management plan review process. The next way that we add value does differentiate us from a lot of the other timber groups in that we build out operating companies. So wherever we have a land base, we hire folks, and they're actually owned by our funds. So they're not Lyme Timber employees, but they're actually owned by our investment funds, and they are tied to the forest land that we acquire in that region. And that allows us to capture sort of the first and second baby steps in the value chain, allows very focused management. We're not relying on third-party consultants, nor can any of our investors ever express the frustration of us over managing or overbuilding on a property because they get the benefit of the margins that these operating companies produce. We also, and this isn't in the slide, but we've also been lucky enough to attract below market rate financing. And it's something we'll talk about in the ag conversation as well, through the federal new markets tax credit system, through our loans that we receive from our NGO land trust partners, and then most recently by accessing the state revolving loan fund, Clean Water Revolving Loan Fund in the state of Pennsylvania. Then we operate the property, and 6, 7, 8, 9, sometimes 10 years later, we sell it to another timber investment group. We've been fortunate enough to realize all of the assets in our first fund, which was vintage 2001. We've now realized all of the assets that were in our second fund, which was vintage 2005. And we're about halfway through the realization process in the assets that we acquired in our third fund, which was vintage 2010. And as of last week, we've gotten to about the 90% capital deployment rate in our current fund, which is fund number 4. So there seems to be enough opportunity for us to continue to invest in this space. Can we go to the next slide? Just as an area that I think we're kind of brave to be investing in, and notwithstanding what's going on in the White House, coal country in Appalachia has experienced some very severe economic distress. Southern West Virginia, as well as northern West Virginia, have remarkable forests from both habitat perspective and species composition, but they were the stepchild to other industries in that area, principally coal and gas and oil. And we have decided to make a major investment in Southern West Virginia. And in this case, the conservation easement isn't a major driver here, but the fact that the property is enrolled in and will have a series of carbon credits sold into the California compliance market is essentially the replacement for the conservation easement value add in West Virginia. But I just wanted to share this little story here. Folks can read it, but if there maybe some of the questions will come out later about why in the world we are investing in coal country in West Virginia. So that's my introduction on Lyme Timber. Take it away, David.
Thank you, Peter. Appreciate the overview and joining us for this. And thank you to everyone who has joined as well as a participant. My name is David Nicola, founder of Blackdirt Capital. We are an operator and an investor in the sustainable agriculture space. As Amy outlined before, we do have a specialized focus in grass-fed beef. We think it's a supply-constrained market in this country that is growing very quickly. And obviously there are certain impacts affiliated with the production system that can be more positive than much of the other agriculture production systems that are out there. So just a real brief intro to Blackdirt. We have a fairly straightforward strategy right now, really only doing it in beef cattle, but it certainly can be relevant for dairy. It could be relevant for grains at some point in the future. We purchase farmland on behalf of investors, and we produce cattle. Retrofit the infrastructure, restore the pasture, really improve the land, both in the beginning to make sure you can produce cattle, but also with the cattle, as many of us on the call probably know, given the Allen Savory methodologies. Third, we scale our strategy to meet growing demand. Our demand right now is 5 to 10 times what we can produce on currently, and we expect to grow into that over time and see that demand grow. And fourth, we create impact. And this impact really is for multiple stakeholders in the value chain, but I think you can categorize it in 3 ways, one of which is environmental, and it's less about conservation. Not that we have anything against conservation, it's just unlikely that there's going to be large conservation benefits per se on a high intensity cattle farm, at least in the region of the country where we are. So it's more about carbon storage, water, reduction of erosion, etc. The second would be animal welfare. So our cattle are happy cattle, right? They're outside grazing 365 days of the year. They barely ever need a vet. They don't generally have any issues. They have full access to water and shade and ample food. And then the third would be the human health benefits affiliated with a healthier product, either through lack of commercial inputs or industrial inputs, or the actual health profile of the product that you're producing, whether it's a grass-fed or a pasture-based beef and dairy relative to conventional beef or dairy, or an organic grain relative to a conventional grain. So that's an overview of the strategy. Our next slide just outlines very briefly the current farm that we have. So we are, I guess, an explanation of the sustainable ag market. The sustainable ag market is not nearly as mature, certainly as the timber market. Even the conventional agriculture market is not as mature as the timber market. And certainly sustainable and particularly grass-fed beef is really in its infancy in terms of understanding production, impacts, how to get it done, how to get any kind of scale. So we like to think we're at the cutting edge in the beginning stages of what this could all look like. And in many cases, the investment side of it, as well as the operational side of it, just really haven't been figured out. So that provides an opportunity to do something akin to what Lyme does in timber, and potentially before other folks get there. But it also leaves room for determining what that could look like in the future. So our current farm, grass-fed beef finishing farm, very simple. We buy in a calf at 600 or 700 pounds. We grow it to 1,200 pounds and we sell it to our buyers. It's irrigated former commodity cropland, used to grow corn, peanuts, and cotton. It's been tilled over and over and over again. We run a low-till and no-till system on it. We grow about 3 to 5 times as much biomass as any corn, peanut, or cotton producer can grow on this farm, with about the same amount of water and the same amount of sunlight and the same and fewer inputs. And then we produce cattle on that increased biomass, which are, again, grazing 365 days out of the year, eating grass and only grass, and are finished of a quality that is proving to be a strong product in the grass-fed marketplace and the expanding marketplace. So the third slide, really just an overview of the impact. I think we've already touched upon it. It's less about conservation, not that there's, again, I'd love to have a better conservation impact for this strategy, but this is intense farmland that is being retrofitted to a just different type of intense farming system. So it's really more about the carbon and the soil, and certainly around the edges, there's an opportunity for conservation, either from mostly for bird populations. But generally speaking, the impact is related to soil, carbon, healthful food, and erosion. And as referred to earlier, this is a sustainable intensification, if you will, which if you go and look at the Nature Conservancy's agriculture program, that's what they like to talk about. But we're producing a lot more biomass on a per acre basis with roughly the same water input. And that's not just grass biomass, but also beef equivalent, so pounds of beef equivalent biomass. And we believe that over time, the quality can be very similar. And we know there's a large debate going on, but we actually think and believe and have seen that the carbon sequestration potential outweighs any of the potential quote unquote methane issues with respect to cattle, which again is a very nuanced conversation, which happy to talk with anybody about offline. But generally speaking, sustainable intensification, transitioning farms, there is an investment opportunity, there is a production opportunity, there is an operational opportunity throughout the value chain. We happen to be focused on really the land and the operations and seeing how it kind of shakes out in the marketplace in the future.
Well, great. So I thought I could now share a bit of my perspective and Lyme Timber's perspective on the sustainable ag space. I thought David did a great description of the strategy behind Blackdirt Capital and their initial foray in Eastern Georgia. 25 years ago, what Lyme Timber was doing was relatively unique. Now it is no longer unique. It's a more mature asset class. We are not the only timber investment management organizations to focus on conservation. Half of the TIMOs, that's the acronym for Timberland Investment Management Organizations, own property subject to working forest conservation easements, and 6 or 7 besides Lyme Timber have been sellers of those working forest conservation easements. So they've actually engaged with land conservation NGOs and state and federal natural resource agencies to make that happen. But 25 years ago, it was kind of unique. other people describe it as crazy, but it's been sort of accepted in the marketplace. It's not quite convention, but it's getting close to it. As David indicated, both the conventional agriculture investing space and the sustainable agriculture investing space are newer opportunities for investors. Conventional agriculture has been around almost as long as timber, but it was principally pension funds investing, insurance companies investing at a very large scale, mostly through operators with leasehold positions, but no attention to the ecological consequences of those investments. I would say 10 years ago, starting with Beartooth Capital, who has a ranchland investment strategy, and including Blackdirt Capital, Dirt Capital, Iroquois Valley Farm, Farmland LP, Fall Line Capital, SLM Partners, a brand new group. They're now a handful and a half of private investment entities. Some are structured as funds, some are doing collections of investments. In the case of Iroquois Valley, they're both an investor and a lender in a public REIT structure, which is a little unusual. But we're now talking about not just a single experiment out there, but literally 7, 8, 9, 10 experiments out there who are trying to merge ecological responsibility with sustainable ag investing. And the reason that we follow this is we actually looked into this as an investment opportunity about 6 years ago. And because of Lyme Timber's history of working with land trusts, we talked to some of the leading land trusts around the country that get involved in agricultural land protection. So that was Vermont Land Trust, Maine Farmland Trust, Scenic Hudson, Sonoma Land Trust, and a few others, and said, could you see a role for private capital? And the answer was yes, but candidly, they tended to be in deal sizes that were too small for us to really be able to handle the opportunity costs associated. Our last fund, the fund that we're about 92% deployed, was a $250 million fund. If we were investing $500,000 or $1 million at a time, we either have to hire 20 more people or have our investors shoot us because it was just too many transactions. We did eventually move from farms to ranches, and as I indicated in 2011 or 2012, in partnership with Palmer Land Trust and the Colorado chapter of the Nature Conservants, who we acquired that 25,000 acre ranch outside of Pueblo, Colorado. And we did use the Savory Institute consultants to design our ranch management plan, and we have actually doubled the carrying capacity, the herd size on that property, as well as making the range scientists very happy at the Nature Conservancy in the restoration of native grassland. So, but we didn't forget about ag land, and about a year ago, we began to talk with some of the groups that I enumerated before. In this case, we talked with Fall Line Capital, which is based in California, but has land in 7 states around the US. We talked to Iroquois Valley Farms, which is based in Iowa, but has land, as well as Providence, Rhode Island, but has land in about 14 states around the country. And we talked to Farmland LP, which has ag ownership in Oregon and California. And each of those entities engaged the advisory side of Lyme Timber, our consulting side, to do a desktop review of where their farm ownerships overlapped with solid land trust partners who could intermediate or facilitate farmland conservation easement transactions, meaning we also looked at the jurisdictions that had funding at the county level or state level for farmland conservation easements or APRs or PDRs or whatever they're called, those geographies. And we connected in both California and Oregon. We provided a pathway for farmland LP to monetize some of the value through easements. We're working specifically on a deal in eastern Montana for Fall Line Capital, and we're just initiating the review of the Iroquois Valley holdings right now. So that's kept us connected to these organizations, these investment entities, as well as causes us to stay up to date and up to speed with the evolution of the new Farm Bill, with various state funding programs, and to stay in touch with the couple of dozen land trusts that we know around the country who are really, really good and solid at putting together farmland conservation easement transactions. I should also indicate, and I know I'm going to see him tomorrow in Minneapolis, but Jacob Israelo, founder of Dirt Capital, actually took on a number of the prospective investments we identified 5 or 6 years ago and has successfully pursued the conservation strategies there. Why do we pay attention to this? Well, I'm a perpetual advocate of permanent conservation of land, so why not do it? Second, there is about 4 times, maybe 5 times as much public money available for agricultural conservation easements as there are for forest land easements. So notwithstanding some of the challenges, I do believe it is fertile, and sorry for using that term, opportunity or fertile environment for sustainable ag investors to explore in a pretty deep way the opportunities for doing conservation easement transactions over farmland. There's also the obvious business benefit, which is a return of capital early in the life of the investment, dramatic improvement to the IRR, as well as a at least tax-deferred return of capital to the underlying investors. And lastly, and it's one of the issues that some of our impact investors certainly highlight about Lyme Timber, but it's an issue, I think, for the growing number of sustainable ag investors, it provides permanence. Now, the productive ag use on a property may provide a degree of assuredness that that will continue in the future, but a perpetual conservation easement is a pretty solid indication that the farm will stay a farm, the forest will stay a forest, the ranch will stay a ranch. And for impact investors who have struggled with finding a great impact manager, let's say in the consumer world, but they get acquired by a global company, did all of the impact metrics pass through that change in ownership? And as the experience that Lyme Timber has, we have now sold 1 million acres of conservation easement encumbered forest land to other forest investors. And by and large, they don't violate the terms of the easement. The management of the property is more or less exactly the same as Lyme Timber's management of the property. Our capital can be recycled to our investors and eventually redeployed. And then you just have a growing conservation infrastructure in America. And I would argue, because of water quality issues, permanent farmland is also a great urban development boundary that farmland should be able to play a similar role. So that's what I wanted to share about Lyme's perspective on ag, a little bit of the difference between the timber, sustainable timber, and sustainable ag investment players and markets. And now I guess I'd like to ask Dave a couple of questions, if that would be okay. Is that all right, Dave?
Sounds great. Thank you, Peter.
So you began to touch on this in your introduction, but could you go a little bit further about and maybe focus on soil, carbon, and water, the conservation outcomes? And we're using, for purposes of this webinar, kind of a broad definition. Maybe it's not conservation outcomes, but ecological outcomes that are produced through your investment strategy.
Sure. So the majority of the impact will be related to the soil, which is probably somewhat obvious given it's agriculture, but also the cattle will be involved. So in short, it's effectively a soil improvement strategy, if you will, and we believe that there are a whole host of both financial and ecological benefits that result from that, one of which is your farm is more valuable. Again, that isn't necessarily borne out in the market data per se and immediately right now, but we believe that in the future there certainly will be a soil fertility premium, or even a local if someone wants to come and buy the land and they have to put less fertilizer down, right? So it's really about the soil and the health of the soil for producing a certain level of output. The benefits affiliated with the soil, and again, some of this is not measurable per se in the same way that other parts of of carbon credits or environmental credits are measurable, and that's what is happening in the research over the last few years, is determining how you see the changes in soil reflected in carbon or water or whatever it is the metric is that you want to identify. But for us, it's really about carbon and water. There are some questions and allusions to carbon. There is not a straightforward carbon monetization strategy. Again, the timber markets are more straightforward. I'm not saying that they are definitely straightforward, but it's more straightforward in terms of understanding the carbon monetization strategy or lack thereof for a particular property. It's less so in agriculture, mostly because the research and the assumptions that need to go into determining what the carbon or methane or nitrogen or greenhouse gas emission equivalents are of certain practices haven't really been figured out. And people are working on that, right? We understand that this work is being done, but it's not as straightforward. There is some voluntary market activity that's happening. Most of it is very small scale. Most of it is not really that appreciable on a per acre basis in terms of what you get from financially, but it's certainly work that's starting to occur. For us, we are partners with Clemson University and University of Georgia. University of Georgia did a study over a 7-year period, probably most of the last decade, where they took a farm system that was very similar to ours. It just happened to be a dairy farm instead of a beef cattle farm. And they looked at a former commodity cropping farmland, irrigated commodity cropping farmland that was turned into a permanent pasture system, and what were the carbon implications. And it was roughly 10 tons of carbon dioxide, because there's a ratio between carbon and carbon dioxide. So they report in carbon, but the carbon dioxide equivalent was about 10 tons per acre per year for roughly the length of the study. And so what the read of that in layman's terms is that you have a farm that has been depleted of carbon, and you spend 6 years regenerating it in this particular ecosystem, right? So this is Georgia, and it's a humid environment, and it's warm in the winter, so you're getting microbial activity for a larger portion of the year, and you're taking that base of carbon up over a 6-year period by having a no-till system, having permanent roots in the ground, having more ground cover because you're growing grasses which cover the ground instead of a crop that has lots of rows in between, and by having animals obviously recycle the nutrients. So that's probably what we hang our hat on the most in terms of understanding the carbon implications, the water implications. Again, measurement is not straightforward. That same study indicated conservatively 30% reduction in erosion. What we can see on the farm is certainly that you should be able to improve upon that significantly, and that's a combination of allowing more of the rainfall to infiltrate into the ground due to the ground cover and the way in which your soil functions in a regenerative soil system, as well as the fact that you'll have less runoff because you have less bare ground and open ground compared to, say, a traditional cropping system. So that's really where we focused our efforts in terms of thinking about the ecological impact. Again, to preface any question that's out there, the measurement of it is pretty difficult and takes a long period of time, and even trying to get the universities to come out there and run with it is certainly a job in and of itself. So, but fortunately, there have been some studies done, and that's what we're primarily focused on. And the financial attributes are that we have higher production, we have lower costs, and we're producing a product that has a premium in the marketplace.
I think that's a great overview. I'd like to dig in a little bit. We followed the work of Climate Trust and some of the voluntary carbon system metrics or methodologies and protocols associated with soil carbon. And I would agree with David's perspective that there are quite a few things going on, but they're quite nascent. And I don't think that it is actually quite worth a sell in the Excel discounted cash flow quite yet to hypothesize, a big uptick in your investment return from a soil carbon credit. But that could change dramatically 2, 3, 4 years from now. The one we were able to sort of synthesize the equivalent in the ranch transaction in Colorado by having the conservation easement, and a number of you probably think the only thing I ever think about is conservation easements, but no, I have a fuller life and other things to think about. But I do think about conservation easements a lot, and we were able to, and it was really at the insistence of the Nature Conservancy, that a component of the conservation easement over that ranch was not just the extinguishment of the real estate development potential or the extinguishment of the parcelization of the property, but it also included a prohibition against sod busting. So we could not, and if any of you know Colorado, this is about 40 miles east of Pueblo, notwithstanding the tremendous amount of immigration and population and development and everything in the world is happening in Colorado, but probably not in this census tract. This is a quiet part of the state. There isn't a lot of development, and quite candidly, the give up of development rights was a relatively modest component of the easement valuation process. A bigger component was denying that the easement would deny the conversion of this ranch into intensive agriculture. We weren't able to capture the water savings associated with that, but we were certainly able to demonstrate through market comparables that ranches that did not have prohibitions against sod busting sold for more than ranches that did have prohibitions for sod busting. So that was a synthetic way to begin to monetize what is happening on our ranch in the same way that David explained, using the savory holistic range management technique and intensive grazing, and then essentially removing the cows from the areas that were intensively grazed for a period of up to 2 years, that we are building soil health and in turn building the component of carbon in the soil as well. So just another way to approach this, again, in this case, using the conservation easement mechanism than a soil carbon credit, which, as David alluded to, forest carbon is a more mature ecosystem service because of the cap and trade legislation in California and a compliance market there. It's quite a significant market, and Lyme Timber has benefited from that, what is now a more conventional source of ecosystem service financing. The other area that I wanted to ask David was your investors. Very few people know this, but the very first impact-oriented fund that Lyme Timber created was a tiny fund. It was focused on the state of Vermont. It happened in 1998 or 97, I guess, and lasted a few years and had a good return, but we raised a total of $6 million in capital. So it was a tiny little fund for us, at least, but it allowed us to sort of talk to investors who had both a financial interest in a financial return interest and a conservation outcome interest. That fund then turned into the Lyme Northern Forest Fund, which was our first large fund. So the next fund grew tenfold. So the second fund was a $65 million fund. But our first fund was made up purely of individuals. There was one small family foundation. So it was 6 or 7 individuals, one foundation, and then the principals at Lyme Timber put some money in ourselves. But I just wanted to talk to David to get some sense of your investor base, your near-term sort of soft-circled potential investors. Are they coming from family offices, from institutions, from endowments? Could you give us a little color on that?
Sure. So the current investors that we have really are, you do call it the equivalent of friends and family, if you will. And so it's mostly been high net worth individuals and smaller family offices that are interested in this space or interested in the entity itself. And by the space, that either means sustainable agriculture or grass-fed beef, or the fact that it's a growing sector. And so what we're seeing in the market with respect to agriculture land investment is that obviously it's a pretty hard sell to get investors into any kind of fund structure for sustainable agriculture if you're not, if you are outside of the typical conventional ag lease paradigm. And I think I would probably say that most of the peers, whether it's the farmland LPs or the Iroquois valleys, probably would say the same thing. There's certainly a lot more farmers looking for or entities looking to operate on the land than there are investors looking to invest in the land. And we're seeing that we're probably a little bit early in terms of the sector, but that's a growing sector. Growing sector, you want to be a little bit early rather than late for this being an investable strategy in the same way that even timber with conservation benefits is really a strategy that you can put a pitch together. Obviously, you have to be good at what you do, so it can't be anybody that does it. But Lyme Timber can put a pitch together and can get investors to say, "Yes, I get it. I understand. I've seen it before. I know how you do it. Okay, I'm in for the next round." I think that is less common in this space. And so that usually requires an investor that has a greater risk appetite. And if it's an institutional investor, they generally need to be much larger, as Peter alluded to earlier in his conversation. Some of the early deals in the 1s, 2s, 3s, 4s, 5 millions, that's just not anywhere close to what you need to do for addressing some of the institutional scale that's out there that has an interest in agriculture. And that's generally the conversations we've had, and I'll stop after this comment, is either not really that interested because the return's too low, which is generally what you get from individuals who are risking a portion of their play money in something that they want to see a higher return, or I need another 0 or 2 after the end of after the size of the strategy in order to even consider it. That's really been most of the response that we've seen. So trying to target the folks that exist in between there obviously is a long haul.
Well, I think I can't tell you when when there'll be the sort of tipping point of scale that David alluded to, when either platforms of investors who are advised by regional or national investment advisors, or institutions like college endowments or university endowments or foundation endowments or public agency pension funds, are going to be attracted to this space. But one of the issues that I think suggests that there's a chance that will happen sometime in the next 5 years are just some of the things that David spoke to, which is soil quality and water scarcity. Agriculture is a gigantic consumer of what is becoming a more limited resource in the United States of America, and that's water. And so if you're competing with metropolitan water users and agriculture, notwithstanding that agriculture in rural America has done pretty well in those allocations, in those battles for the last century, that may be changing over time. And water strategies that utilize less water and potentially either reduce runoff or reduce the impaired quality of runoff will be very important as well, particularly when water utilities and water users are getting sensitized to the economics of cleaning water and those kinds of things. So I'm somewhat optimistic that scale will begin to occur. A challenge will be regional knowledge, local knowledge, the ability to find, manage, recruit, incentivize regional operators. So is there kind of a national rollout? My perspective is probably no for now, but there might be a few dozen entities that grow in scale but still have the sort of proprietary regional knowledge to perform at an alpha level. So I'm going to stop now. I'd like to turn it back to our lovely moderator because I'm hoping, well, I haven't seen it on my screen, that there are some questions hopefully for David, or at least the hard questions are for David.
Great. Yeah, thank you, Peter and David, for that great discussion. Yes, we do have several questions from the audience, so I'd love to hear about that. So first of all, one audience member is wondering, what are the implications of stacking carbon and conservation easements on the same property? Can that be done? How did the two interact? I know you're talking extensively about kind of those strategies.
So stacking conservation easements and carbon has happened quite often. In fact, if you looked at the approved improved forest management carbon offsets projects at the Air Resources Board in the state of California, probably 2/3 of them are projects that have a conservation easement in place and that the landowner, or sometimes the next landowner, has decided to pursue a carbon project. If the conservation easement is a forever wild conservation easement, meaning it doesn't allow management for economic gain, then you would not be able to do a carbon deal. But Lyme's experience in Maine and Tennessee and West Virginia indicate that properties subject to a subject to a working forest conservation easement can, and as a reserved right in that easement, is the monetization of ecosystem services. It's great if that's actually enumerated in the easement. And as long as the carbon monetization scheme, in this case, compliance, improved forest management offset credits in California, do not in any way erode or negatively impact the underlying conservation purposes of the conservation easement, they seem to work hand in glove. But if the easement precludes ecosystem service monetizations specifically, if the easement does not allow forest management, and meaning that the forest has to stay at the volume that exists right now and cannot be diminished, then you would defeat or not be able to pursue a carbon transaction.
Great, thanks, Peter. So this question is for Dave. We've gotten a few questions about grazing intensity. So it'd be great to hear a bit more about how you manage grazing. As an example, one listener wrote in that there is a debate underway regarding whether heavy or light grazing better serves soil carbon sequestration. So what is your position on that, and how does it affect Blackdirt's operations?
Sorry, I was on mute there for a second. I was just going to ask if I should be writing back to some of these questions. I didn't press send, but I'll try to answer a couple of the cattle ones. Now. So one of them is intensive grazing versus management intensive grazing. I think that's just the semantics. There's literally 10,000 terms for management intensive grazing and holistic management, and people use them all interchangeably. So I think that's just Peter and I saying intensive grazing when we mean management intensive grazing. We're all referring to the same thing, which is rotational grazing, in which you're paying attention to how your cattle react to the land and what residual is left, which residual means how much of the grass do you graze. And so I think that gets into the question about heavy versus light grazing. I don't really understand what that means, and that's because it's obviously a question that's written down very quickly, so we'd probably have to have a discussion on that. But my perception of heavy versus light grazing is light grazing would be you don't take a lot of the grass off. Heavy grazing, you probably take too much of the grass off. The answer is it's in the middle. And of course, it depends on how you define heavy or light. I would think that with respect to soil carbon sequestration, it's somewhat irrelevant, the level of grazing within a certain range, but the soil carbon sequestration potential is going to be related to whether you are regenerating the land or you're degrading the land. And if you graze heavy and destroy the land, which you wouldn't be in operation if you do that. At least that's there's no way to be able to make money if we did that. That would that would be damaging to the soil and presumably damaging to carbon sequestration potential. And if you don't graze enough, which is obviously the whole point of the balance to everything, you don't graze enough, you don't actually benefit the soil because you don't get the nutrient cycling. So it's dependent upon how you define it, and it's usually in between, and each species will have kind of a range in which you want to graze a certain amount and leave a certain amount of residual so that it can be incorporated back into the soil. And we do that based on the expertise of our managers in terms of understanding what we want to leave and where we see the either cattle reacting or the land reacting to certain practices. Let's see, the other one. There was another question about, margin differences between grass-fed and grain-fed, and quality differences, very, very dependent on operators, management, genetics in the region. You can make a lot of money in grain-fed, you can make a lot of money in grass-fed, you can make no money in grain-fed, you can make no money in grass-fed. Totally depends on the quality of the management. And it's not straightforward because grass-fed generally has a much higher cost of production, but our cost of production is low relative to the industry. Grain-fed, lower cost of production, but we all know that's because of the health, environmental, and animal welfare externalities that are not priced in. Quality is generally also related to the same things. You can get a prime and choice and high quality beef that tastes really good. That's 100% grass-fed, grass-finished, and we produce a lot of choice animals on our farm. And you can do the same in grain-fed, or you can get a really low quality beef that's also grain-fed. So it's very dependent, but we're in at the early stages because we know there'll be a big differential and a price differential between the quality, both of the practice and of the product at the end. So I tried to fire off those three. I don't know what other questions there are as well.
Well, there's I see one about potentially capturing some of that value that David just talked about creating through the managed intensive grazing on the property. And I've had a conversation, this is not a direct answer, but it'd be interesting for some of the CBay folks to think about, as well as some of the folks that are listening on this webinar, which is there is in sort of urban planning and kind of concentrated densifying cities, there's something known as a location efficient mortgage. The idea being that if the residential development is close to a transit stop, the parties that are occupying that development, the buyers of a condo or a house or renters, should be spending less money on their transportation needs in the form of a car. So could Fannie Mae and Ginnie Mae have underwriting standards that sort of acknowledge that, meaning that they would have an ability to have greater debt service or ability to service greater amounts of debt because they had less costs associated with owning and insuring and putting fuel into and parking an automobile because they were within a block or two of a mass transit stop. So the conversation I've been having with folks at Environmental Defense Fund is there eventually going to be an enhanced soil carbon mortgage, which is a little crazy, but I'd love any of you to think more about this with me over the next little while, which is because of reduced expenses associated with inputs, meaning fertilizer principally, should the farmer be able to borrow money from farm credit or ag credit at a slightly higher level, meaning could they borrow more money, because their ability to service that debt would be greater because they'd be spending less money on inputs. I may be out over my skis a little bit on this one, but it'd be interesting to get the group to think about this together a bit.
Great, thanks guys. I want to direct a question to Dave from the audience. One viewer is wondering, are there aspects of the management or operation strategy in your first investment that will accelerate your future projects? In other words, will future investments tend to be increasingly efficient in either capital management or impact generation?
Yes, definitely. That is part, I think that the industry in general, so let's call it, there's agriculture, sustainable agriculture, and then there's subsectors. And there are a lot of either production strategies or investment strategies that still need to be figured out. And for us, we're using a relatively new system. Again, there are some individuals who have used it in the past. It's a common system in New Zealand. It's adapted really with some some ecological attributes to the U.S. and to the Georgia region. And it will certainly improve next time in terms of efficiency of the capital investment, in terms of how much infrastructure you need to put on, and then an understanding of how you have to scale or how you have to set up your operation in order to optimize financially. And for us, optimizing financially generally means we're producing more of the ecological benefits over time, because we're regenerating more of the land, and we're running cattle through in a way that allows more of the land to be utilized and more of the nutrients to be cycled. So the simple answer is yes.
Great, thanks. And then we just have time for one more question. Dave, following on Peter's comment regarding the need for regional operators, what is your experience in finding and working with regional operators who can farm at scale? Are you concerned about a lack of operators in the geographies where you work?
Definitely, and that's why we are now the operator. So we're in grass-fed. There generally is not an opportunity to set up buy land and lease it out to the operator strategy, unless you want to do $500,000 or $1 million at a time and then not be able to really sell your product. So we are if we invest in land, we're investing on behalf of somebody. It's not something that could, just like a fund, right? It's not coming through our business per se, but we are the operator on the land. One of the reasons is because there really isn't a lot of capacity out there. And the second is much of the capacity that is out there that is either qualified or interested in doing this work does not have the land resources to do it themselves, and does not have the capital to run the operations, and they would prefer to be an employee. And if they want to be a long-term employee, they're part of the company. If they want to just be a contractor, they can be a contractor. If they want to leave after 2 years because they made enough money and they want to run their own cattle operation, no problem. But yes, the lack of operators is certainly a problem for investors. It is not a problem for us, because we're going to be the operator, and we think a farm management business is really the only way you are going to get grass-fed at scale in this country. The grass-fed system is going to look exactly like the feedlot system, except the feedlot will be replaced by a positive environmental asset, which will be a farmland asset that produces cows with higher animal welfare standards, cattle with higher animal welfare standards, higher human health standards, lower vet bills, lower issues, regenerated soil as part of that process. And that's going to have to come at scale. And my humble opinion, the only way it's going to come at scale is you've got a couple ranchers and farmers that are going to be able to build some scale themselves. But generally speaking, it's going to have to be businesses that are both brands and then farm management companies doing it. So we've kind of accidentally gotten into that because it was necessary to get the first asset up and running, but we're really transitioning to a focus on that. And then we raise money to buy land with investors that we know, great, if it's a farmland fund wants to buy the land, then we can buy the land with a farmland fund. So I don't think there's a concern about the lack of operators. I think that is your typical situation in which you have a growing industry in which the folks that are the most creative and likely have learned the most are younger, so less of a track record, so they don't really have any capital. And you need to formulate a system so that they can actually function in it and help it grow, and that's what we're trying to do.
Great, thanks, Dave. And although we have more audience questions, unfortunately we have run out of time. We'd really like to thank our speakers, Peter Stein of Lyme Timber and David Nicola of Blackdirt Capital, for a really wonderful, thought-provoking discussion. The recording of this webinar will be available on our YouTube and iTunes channels, so please check back for those later. And last but not least, be sure to check out the CBAY website and newsletter for more information on upcoming webinars. Until next time, and on behalf of my co-host Corey Scott, who's covering everything behind the scenes today, this was Amy Tourget from the Yale Center for Business and the Environment. Have a great day.